Welcome to the first video within this lesson. In this video, we're going to be covering continuation patterns. Just like we went over in the last video, continuation pattern is a pattern that forms within the markets that tell you that the current trend that is going on is going to continue. It is what it just sounds like. So if you're in an uptrend and you find a continuation pattern, that uptrend is going to continue. Same goes with a downtrend. If you're in a downtrend and you find a continuation pattern, that downtrend is going to continue. Usually continuation patterns are known as consolidation patterns because they show us that buyers or sellers have to take a quick break before continuing buying or selling. So essentially it's a point where the buyers have made a giant spike within the market, and you can see that with an uptrend or a downtrend, whatever it may be, and then they're consolidating. So they're deciding what everything's going to go on and taking just a quick break real quick, essentially. That's when you find your continuation pattern is within that consolidation. You'll find that continuation pattern that signals whether the trend is going to continue. In this continuation video, we're going to cover several different chart patterns that signal a continuation within the market, from wedges, rectangles, and pennants. You also have to note that wedges can be considered a reversal pattern as well. So when we cover those, just remember, we'll kind of go over it, that these can also signal a reversal, but we'll cover that later on. Continuation patterns form within the market when there's that consolidation like I was talking about. So it's a quick pause within the market. It's like the people that are buying and selling, traders, are catching their breath before taking that further leap with going long or going short on the pair. The first continuation pattern that we're going to look at is a bullish flag and a bearish flag. Now obviously I just said two different things, bullish and bearish. By now we know that a bullish means up and then a bear means down. So what do you mean when I say both of those? Well, they're two separate patterns. A bullish flag is a continuation pattern that is going to the upside, going long, so a buy, continue to the up. And then a bearish flag is the exact opposite. It's a downtrend continuation pattern, so it's a flag forming to the downside. A flag is a chart pattern used in technical analysis. Although it's less popular than triangles, wedges, and other commonplace technical analysis tools that traders use, traders consider flags to be extremely reliable consolidation patterns. So it's a pattern that traders actually like to use a lot and like to trade off of. Now we're going to pop up an image of a bullish and a bearish flag right now. Let's take a look at the bullish flag. A flag is formed when price shoots up extremely sharp in a single trading period, forming a near vertical line. Now, I said near vertical, so this does not mean it has to be completely straight up and down. It's most likely going to be at an angle. You can see right here we're pointing out what we call the flagpole. This is the sharp point in movement within the bullish flag. The flag pattern is a short-term movement that shows trend continuation. It shows that the previous trend will continue in the direction, and overall buyers, in this case that we're looking at the bullish flag, will continue to move the pair to the upside. Now if we're looking at a bearish flag, sellers would move it to the downside. A flag pattern is represented by two parallel lines, a support and resistance, holding the range between the highs and the lows, with visually forming a parallelogram or a flag. Generally it's directed against the main trend. So if we're in an uptrend, we'll normally see this little downside movement channel that forms what we know as the flag. That's if we're in a bullish flag. Now if we're in a bearish flag, we will see a movement to the upside. So if we're in a downtrend with a bearish flag forming the flagpole, we will now see a slight channel to the upside that forms the flag. Like I was saying, the flag pattern is identified by two main elements: the flag pole or the flag post, and then the flag. The flag pole is typically a strong price action movement within the pair, and then the flag is a point of consolidation within the pair. A bearish flag is characterized by a sharp drop in price. Now, that is soon followed by a consolidation period, typically to the upside. Just a slight parallelogram to the upside. Now, when looking at flags, you'll have to kind of wait for the break. Now, this break might come a lot sooner in some cases, or it might take a little bit longer. So you always have to wait for the breakout of the flag pattern. To measure your target price or to find your take profit levels within the flag pattern, what you'll do is you'll measure the flag post or flag pole, the distance of that, the height essentially, and then all you do is take that exact same distance, and if it's a bullish flag, put it on top, and that's going to give you a general range of where your first target could be, or one of your targets. Now you'll do the same thing for a bearish flag. You take the flagpole and get the height of it, and then you essentially put it towards the bottom. So where the breakout would be of the bearish flag, you put that exact distance of what the flagpole is, and then that'll give you your levels of target. We have a short little video for you guys to check out going on some more flags.
A bull flag is a bullish continuation pattern. It comes after a strong move upwards and consists of a flagpole as the strong move to the upside and a consolidation phase, which is known as the flag. Let's take a look at the charts. As you can see, there has been a strong bullish move, but as the market needs to adjust to the new higher prices, it goes into consolidation phase and the price retraces lower in a narrow range. Take a note that for it to be a proper bull flag, the two lines forming the flag need to be parallel and often will be sloping downwards. There are two basic approaches to enter the market with this pattern. Aggressive traders will enter at the bottom of the flag for the maximum profit. Conservative traders will wait till the price is broken out from the formation and only then enter the market. The price target for this formation should be the height of the flagpole, measured up from the bottom of the flag. A bear flag is a bearish continuation pattern. It comes after a strong move downwards and consists of a flagpole as the strong move to the downside and a consolidation phase, which is known as the flag. Let's take a look at the charts. As you can see, there has been a strong bearish move, but as the market needs to adjust to the new lower prices, it goes into consolidation phase and the price retraces higher in a narrow range. Take a note that for it to be a proper bear flag, the two lines forming the flag need to be parallel and often will be sloping upwards. There are two basic approaches to enter market with this pattern. Aggressive traders will enter at the top of the flag for the maximum profit. Conservative traders will wait till the price is broken out from the formation and only then enter the market. The price target for this formation should be the height of the flagpole measured down from the top of the flag.
Alright, so let's take a quick look at and draw up a bullish flag. So with a bullish flag, we know that we have a flagpole that is formed. And this is the sudden spike in price. The flagpole is then followed by a channel against the trend. Let me draw price in as green real quick. So remember, this is price. Price comes in, gets rejected off this resistance. And remember, all the flag is a sloping down channel, resistance and support. It gets rejected off of the support, back into the resistance, comes back up to, goes back down to the support, and then pushes back up to the resistance. Now this is where we see a break. we see a break of the bullish flag, and we'll either see an instant spike in price or we'll see a pullback to now the support, and then see the spike. So you actually have two different entries. This is a stronger confirmation because it might not always come back to here. It might just spike right away. But if it pulls back, this is an amazing entry that you can have to have this support. Now remember, when finding your target price and target level for your take profit, what you're going to do is measure out the height of the flagpole and take that exact level and put it over here. Now, it might not be exactly even here, but you say this is 100 pips, this is going to be 100 pips. So now your flagpole signal just got you 100 pips. Now going off of that, let's do the exact opposite, a bearish flag. So in a bearish flag, we have the exact same thing as a bullish flag, it's just opposite now. So now we're in a downtrend, this is price, remember, and we see a pullback against the trend, creating our flag. So we have price comes in, gets rejected off of it, off the support, comes up to the resistance, back to support, back to resistance, back, and it can go quite a few times. And also look, now we've got a triple top forming. Now we'll see the break and instant price surge, or let me extend my line just so you guys can see it a little bit clearer. We'll see the break in price now, or like I said earlier, see a pullback, and this is probably the best entry you'll get, and then you see your price. Same goes here, measure it out, say it's 75 pips. This target is now 75 pips. And that is a bullish and a bearish flag. Now going off these two patterns that I just drew up real quick, a bullish rectangle and a bearish rectangle is the exact same thing as these flag patterns, except it's not a pullback against the trend. So what you'll normally see is, you'll see it more like this. So price is moving, and it's just not against the trend, the flag pattern formation. Some people still call this a flag. You can if you want, but it's technically called a rectangle. This would be a bearish rectangle, and a bullish rectangle would be just the exact opposite. That's going to wrap it up for the whiteboard, bearish and bullish flags. Now that we've looked at bearish and bullish flags, let's take a look at pennants. Just like the flag, a pennant can be both bearish or bullish. A pennant is a formation that is also a continuation pattern that signals a continuation in the overall trend. So just like the flag, and since we're looking at continuation patterns, if you see a pennant form, it is going to suggest that the pattern is going to continue with the trend. So it's signaling the trend continuation. Although a pennant will act similar in nature to a flag pattern, the actual look of a pennant is more like a triangle pattern. At first glance, the bullish pennant may appear to look very much like a symmetrical triangle, which we'll get into later on here in a minute. But on closer inspection of the actual pattern formation, there's typically a smaller size in a bullish pennant, and the duration of the volume tends to be a little bit shorter in the pause as well, so which helps increase the breakout of it. So it's a shorter time period essentially. It'll happen a lot quicker. The pennant is also not to be considered as volatile as a symmetrical triangle. So we're going to get into that here in a little bit. Like I said, a symmetrical triangle can continue the market or it can reverse it. The pennant doesn't have as much volatility as a symmetrical triangle. The pennant is often interpreted as a brief pause within the markets following a strong price movement. A bullish pennant, one that performs in an uptrend, will result in prices breaking to a higher side, while a bearish pennant will result in the exact opposite, breaking to the lower side. With buyers and sellers taking a quick break and consolidating, the price usually consolidates, and you'll see that in the little form of a tiny symmetrical triangle. We're going to pull up an example right here of a pennant. Here we have an example of a bearish pennant on the screen. A bearish pennant is formed during a steep, almost vertical downtrend. After that sharp drop in price, some sellers close their positions while other sellers decide to join the trend, adding new positions in, making the price consolidate just for a little bit. While the price is still consolidating, more buyers or sellers usually decide to jump in on the strong move, forcing price to burst out of the pennant formation. As soon as enough sellers jump in, the price breaks below the bottom of the pennant and continues to move down. Now we have a bullish pennant on the screen. Just like the name suggests, it signals that bulls are about to take charge again. This means that the sharp climb in price would resume after that brief period of consolidation when the bulls gather enough energy to take price higher again. Just like we predicted, the price made another strong move upwards after the breakout. To play this and to trade this, we'd place a long order, also known as a buy obviously, above the pennant and our stop below the bottom of the pennant to avoid fakeouts. That way, just in case if the market does push to the downside in a bullish pennant, you would be stopped out. Like we discussed earlier, the size of the breakout move is around the same height as the mask. Now, it can obviously be more, like we said. Here we have another little clip prepared for you guys to show you more on bullish and bearish pennants.
Bullish pennant is a bullish continuation signal. It is very similar to bull flag formation and consists of a strong move upwards as the flagpole and a consolidation phase known as a pennant. The pennant is formed when the support and resistance level lines converge and leaves price no choice but to break out. Take a note that for it to be a proper bullish pennant, there can be no more than 30 sessions forming it. Let's take a look at the charts. Here you can see the price has had a strong up move, but as the market needs to adjust to the new higher prices, it goes into consolidation phase. As the resistance line is sloping lower and support level is sloping higher, the breakout is inevitable. So where to enter the market? You enter after an upside breakout and target the height of the flagpole measured up from the bottom of the pennant. Remember, if the price is broken to the downside, the pattern is not to be traded, as this is a bullish pattern. The bearish pennant is the exact opposite formation. It is a bearish continuation pattern and you can find it after a strong down move. You enter the market after a break to the downside and target the height of the flagpole measured down from the top of the pennant.
Let's head to the whiteboard and check out a bullish and bearish pennant. Now let's head to the whiteboard and draw up some bullish and bearish pennants. So if you remember, a bullish pennant is just like the flag, has a pole, mask is also what it's known by. But then it is followed by, let me draw these in lines real quick. Sloping downward. Sloping downward. I'm going to draw a price here in green. And it's just like the flag. Bang. So, just like the flags, all we have to do is take this, put it here, 50 pips, this is 50 pips, this is a bullish, pennant. So as you can see, we had price have a big surge up, then sellers kind of came in, took it over. As you can see, we have two lines kind of sloping inwards, and then that's kind of what gives us our target price here in blue. We had a break to the upside. Now, just like the flags, it might not always have a giant spike right away. It could go like this and then have the spike up. And this is honestly the better entry just because it had the pullback to retest the line. Remember, all these lines are support resistance. They're kind of sloping zones. Now, going off of that, we now have the exact opposite. Let me erase this real quick. We now have a bearish pennant that we're going to draw up real quick. Sellers come in. Green is price. See a breakout. This is our sell to the downside. Now to measure, let's say it's 60 pips. We'll take it 60 pips. Now, you'll notice that it doesn't always go exactly how it is, but it's relatively pretty close, and then it might even go more like it did in this example. So this is where it comes in trade management, where you can place a tight stop loss, where if it does retrace a little bit, you will get stopped out. Or if you want to play it a little wild, I guess so to say, and you think it's going to go even further depending on how the market structure is and where it's set up, and let it ride a little bit longer. Or if you have multiple positions, what's cool about this is you can close one position, secure the profits, and then let one ride. Now, a big thing what you'll see is, and what we want to look for when we're finding all these pattern formations, is we could be inside of a giant channel. So this is going to signal to continuation to the downside. So you might have a channel way up here, and this is what's going to fill. So in between the channel, instead of catching a big reversal, you're catching the continuation to continue it to the bottom side, or vice versa. If it's coming from the bottom, continue to the top side. And that's kind of where we will work in the next lesson and the following lessons off that, how to incorporate all of these different patterns and actually using them how to trade. Now let's look at wedges. Wedges are also chart pattern formations that form within the markets that we use in technical analysis. A wedge is formed by taking two trend lines for the price behavior over an asset, over time. If the trend lines converge and form a wedge, that's considered as a wedge. So kind of going a little bit more in depth over that. If over time the slope of a high price trend line exceeds the slope of a low price trend line, then that forms a wedge. And also, if the slope of a low price trend line exceeds the slope of a high price trend line, then it forms a wedge. Here we're going to pop up on the screen an example of a wedge. As you can see, price gets tighter and tighter as it gets closer to the end of the wedge. Now there's two types of wedges. There's a rising wedge and there's a falling wedge. Now this is where it gets a little bit tricky, and we're going to touch on wedges a little bit more in the next video, just because wedges typically aren't only considered as continuation patterns, and that's what we're focusing on in this video is continuation. But wedges have a part that can signal a continuation within the markets, but wedges can also signal a reversal within the market. Now, you might ask yourself, how do you determine the difference between a rising wedge and a falling wedge, and whether they are going to continue the market or reverse the market? It's simple. You just have to remember, if a wedge is moving against the current trend, that's the pretty much indication that the trend will continue as it is. So if we are in an uptrend and we've got a falling wedge, it typically signals that the uptrend will continue. Now vice versa, if we're in a downtrend and we have a rising wedge, the downtrend will continue. A rising and falling wedge is represented by two converging trend lines, support and resistance, visually forming a triangle. Both trend lines are either upward sloping in a downtrend or downward sloping in a uptrend. Wedge, it forms in the opposite direction of the trend. With a rising wedge, as you can see on the screen, a sell signal arises if the pattern is formed in a downtrend and then the price falls below the support line, as you can see on the example, which the price did, which continued the market. When we were in the downtrend, we had a rising wedge form, which was against the downtrend, and then continued the market once we saw a breakout to the downside of it. Now going off that, vice versa, now we're looking at a falling wedge. A buy signal arises if the pattern is formed in an uptrend and the price rises above the resistance line. So here in this example on the screen right now, we are currently in an uptrend and then we have a falling wedge that kind of does a little pullback, and then we see a break to the upside out of the falling wedge, which signals the continuation within the market, continuing the uptrend.
Falling wedge is a bullish formation pattern where price makes lower lows and lower highs, but the resistance line is steeper than the support line. Every new low is created with a loss of momentum and is signaling about underlying strength. Bullish continuation pattern. It forms after a strong uptrend as the price retraces lower. As the main trend is still bullish, there is no momentum behind the bearish moves, and eventually price breaks to the upside to resume the bull trend. The price target for this formation should be the height of the wedge, measured up from the breakout point. Rising wedge is a bearish formation pattern, where price makes higher highs and higher lows, but the support line is steeper than the resistance line. Every new high is created with a loss of momentum and is signaling about underlying weakness. The second variation is a bearish continuation pattern. It forms after a strong downtrend as the price retraces higher. As the main trend is still bearish, there is no momentum behind the bullish moves, and eventually the price breaks to the downside to resume the bear trend. The price target for this formation should be the height of the wedge, measured down from the breakout point.
Let's take a quick look at a rising wedge and a falling wedge. Now we have to remember, these can be also reversal patterns, but in this example we're going to be looking at it and using it as a continuation pattern. So let's start off with a bullish rising wedge. Or no, let's start off with a falling wedge. So with a falling wedge, what we're going to see is we're going to see a spike in price. So we're in an uptrend currently. And then we'll see price kind of form what we call a wedge pattern formation. And this is a falling wedge. So as you can see, we have an uptrend that is falling into a wedge essentially against the trend. And this is what signals us that is a continuation within the trend pattern. Now if this was the opposite direction, it would be a reversal pattern. If it was this way, it would be a reversal pattern. But we're looking at a continuation pattern here. So we have the price that surges up, comes in the wedge pattern formation, and all this is a line of support. Resistance. Just like all other pattern formations, price will then break out, and once it breaks out, this is when we have our buy order, buy signal. That's what tells us. Now if it would happen to break to the downside, it would cancel the trade. That would be a false breakout most likely, and you just would not want to trade it at that point. Same with the other ones. What you would do is take the measurement, let's add it in, say it's 25 pips, 25 pips, that's where you find it. So let's kind of look at a rising wedge now, which is the exact opposite of this falling wedge. So now we're actually in a downtrend. So now we have price coming in a downtrend, and we have a wedge that kind of forms like this. And you'll notice wedges don't typically close off at all. That's what separates them from triangles. So we'll have price come, and same thing as we have our spike in price. We kind of get stopped out. We have support and resistance, and then we'll see a breakout. This breakout is when we'll want to enter. Bam, that's when we come to the downside. And this is where it continues the trend. So we're in a downside, and all it did was a slight pullback, and then continue of the trend. You have to be careful with bearish and bullish wedges just because they are also a reversal pattern. So you have to remember, in an uptrend, if you see a falling wedge, that's a continuation within the trend. If you see in a downtrend a rising wedge, that is going to be your continuation signal that is going to continue the trend to the downside. If it's the other way around, which we're going to cover on here in a little bit, it will be a reversal signal.